Hello trade pros. How would you like to borrow thousands of dollars so you could make money as the stock market goes up and only having to put down 30% of the cost of the stock you're planning to buy? In today's video, I'm going to talk to you about what it's like to buy stocks on margin. So let's get started. So let me explain the concept of what margin is. Who's going to lend you the money? Who do you owe it to? And at what cost does it come? When you're thinking of trading on margin, this means that you're borrowing a portion of money from your broker. Wherever it is that you open a stock trading account, different brokers allow you to borrow a different percentage of a company's value to fund your purchase. For this advantage, your broker charges you an annualized interest rate that's calculated on the daily usage of the margin. So if you only borrow the money for 5 days, you only owe 5 divided by 365 times the margin rate. This margin rate at brokerages is typically prime plus 1.5% on average. This rate is negotiable, however, depending on your trading activity, so I strongly encourage you to take that up with your broker. Before I jump into an example to show you what can happen when you borrow on margin, both when the stock goes up and when the price of the stock goes down, I want to explain to you the benefits of trading on margin and why you would want to look at this in the very first place. The benefits of using margin are that you're able to make more money as the market goes up. If you have the opportunity to borrow a wad of cash and put that in the market, as the prices go up, you make more money in your position. This is called leverage because not every dollar in the position is your own. Therefore, you have exposure above and beyond the cash balance that you have in your account. Now, we all know that this is a benefit. When the stock market's going up and you're long on margin, you feel like a genius investor. You're saying to yourself, well, this whole thing is easy. How come everybody isn't rich? However, the trouble starts to happen to the downside. But before we get there, here's a few other benefits of trading on margin. Now, this is a tax benefit, so I strongly encourage for you to check your tax legislation and consult a professional. But when you borrow money to invest, the portion of money that you're spending on interest to service that debt is actually a deduction for tax purposes. When I worked in one of the big 6 banks of Canada, this was a favorite strategy of a lot of financial advisors. And to this very day, they're suggesting the same thing. And who could blame them? The market's been in a bull market since 2008, and we really recovered from the depths of the sell-off after the housing bubble collapsed. What advisors are actually doing is recommending to their wealthy clients to borrow money and put that into the stock market. This is a great strategy, right? Well, as long as things are going the way you expect. However, we know one thing as investors and traders, and that's the fact that oftentimes we can be wrong. And when we're wrong, we expect to pay a price. Investing and trading is not a 100% success rate business. In fact, it's a risk business, and the reward comes when you manage your risk effectively. The most successful investors are the best risk managers first. Profit is the reward for being a good risk manager. So with that being said, let's explore the downside. What if you borrow money from a company that allows you to purchase stock and that stock goes down? I'm going to jump in next and show you a specific example with the stock company, talk to you about what margin rate is, loan value, and maintenance margin, and we're going to jump into that next. Now I'm going to show you a concrete example of how buying stocks on margin works. First of all, I'm going to take you through some margin slang and what each one of these terms means. They're very important, especially when you're dealing with your broker and you need to explain or understand the situation at hand. Margin in itself, and this is a very often misunderstood concept, is not the amount of money the broker is willing to lend you. Margin is actually the portion of money that you need to put down in that position to receive the loan of that stock. Which brings us to the next term, loan value. This is the portion that you actually borrow from the broker in dollars. Maintenance margin is how much capital you're going to need to maintain to keep the position open. As we're going to see in a moment, as stock prices fluctuate in your favor or against you, the margin or the amount of money you're going to need to maintain changes with the stock price itself. So these are 3 terms you're going to need to understand when dealing with margin, and they're simple to understand once you know what they mean. Now let's talk about margin rates. What is a margin rate? As we just said, margin is the portion of capital that you need to put down towards the trade value. So this is the rate of the total that you're going to need to contribute in cash or to have available in your trading account. No margin means 0%. Some stocks that trade under $5, actually all stocks that trade under $5 are not marginable. They're not eligible for margin. Why is that? Because the price could fluctuate adversely and there's a lot of volatility in smaller capitalized companies. Also, there are regulations in place, plus brokers have policies in addition to the regulations. So you'll mostly find that stocks that are marginable are the ones that are bigger size companies in terms of capitalization. They're more established and they've been doing business for a longer period of time. It's your responsibility as a trader to know the margin values and to know whether or not a stock has margin. Also, some stocks, as they drop below the threshold, will lose margin eligibility and you'll have to put down the rest of the money to hold it. Now, on the flip side of that, for very good blue chip established companies, there's something called reduced margin. This means you need to put down as little as 30% of the stock value to own it, upwards to about 50%. And now that you understand these terms, let's jump in and let me show you a concrete example of what it looks like to buy stock on margin. Let's assume that ABC Co. is trading at $200 a share. The margin rate for this stock is 30% because it's a blue chip, highly established company and the broker is willing to lend you 70%. So your margin capital, 30% of the $200 per share, equals to just $60 per share. Therefore, the loan value that you'll be receiving is $140 per share, calculated by taking the share price minus the amount that you need to put down, and that equals to what you will be receiving as a loan from your broker. That's referred to as the loan value. Therefore, if you want to purchase 100 shares of ABC, you're going to need to have $60 per share times 100 equals $6,000 of cash in your account. The capital you will then borrow to establish this position is the loan value times the number of shares, or $14,000. The total of that is $20,000. And if you go in to cross-check that math, you should see that 200 times 100 shares equals 20,000. Of that 20,000, 6,000 is your money, 14,000 is borrowed. As you can see, that's a pretty heavy leverage and you're borrowing the majority of the position. Alright, now let's have a look at what happens when the stock price fluctuates. I've set up a little spreadsheet for you to demonstrate this example. Let's first shift our focus to the very middle. You'll see this horizontal row highlighted in orange. 200 is the stock price. This is the first column. The second column represents the percentage of change in that stock price. The third column is the value of your account, which is the margin loan plus the amount that you put down yourself. The next column represents the capital that you initially borrowed. The column after that is the equity in the account. And the next column is the MMR. This is the maintenance margin requirement, and it's equivalent to 30% of what you have in the account value total. So as the stock goes up, 30% will be a higher number. As the stock goes down, you'll find that 30% becomes a lesser and lesser number. And lastly, your margin excess or draw, or if you look at this as a profit and loss, this is equivalent to your account equity minus the maintenance requirement for your margin. As we could see, if a stock goes up from 200 to 205, that's a 2.5% gain and a total increase on your account value of $500. You could confirm that by saying $5 times the 100 shares is equal to $500. The loan that you received initially maintains at $14,000. Your account equity is therefore $20,500 less your loan that you received, which is equal to $6,500. Because the stock has gone up, you now need to maintain more margin. It's increased from $6,000 by $150, and therefore you have a profit of $350. As you can see, the more stock prices go up, the more money that you make on that position. However, if the stock price should happen to fall to the downside, you can see that for a 5% loss, or if the stock price hits 190 per share, you have a $700 loss of capital. And this is because even though the maintenance margin requirement has dropped, your loan value maintains at $14,000. The initial amount that you needed for margin to establish this position was $14,000. You owe that as a loan. That does not change.
although you have less that you have to hold on maintenance margin, you owe the difference between the maintenance margin and the margin loan you've received, and that ends up being $700 of margin excess or drawdown. So assuming that all you had in your account was $6,000, a 2.5% drawdown would mean that you're now in the hole for $350, and you would have to top up your account, and we'll talk about that in a moment. Now, here's the interesting part about trading on margin as a whole. If you get a 15% drop in the stock that you own, and I know you're not planning for it, and it happens nonetheless, on a 15% drop of the stock, you lose $2,100 of capital on an initial balance of $6,000. Therefore, a 15% drop leads to a 30% decrease in your trading account balance. And this is why when you have margin, you have leverage. And whenever you have a margin call, you need to take some actions to recapitalize your account. This is what we call the dreaded margin call, and here's how it works. When your broker calls you, most of the time these days, they'll email you, and if it's really fierce sell-off and there's a lot of clients who are being margin called, they may not even call you. At the end of the day, in the customer agreement, it specifically says it is your responsibility to maintain your margin account. However, at times they will send you a call or an email and say, hey, you need to top up your margin account by doing one of the following actions. You could either deposit cash to meet the margin requirement, which is the 30% of the position, or the maintenance margin requirement, the MMR. You could deposit securities that you own from another account or another institution that have the equivalent of margin value required, which is a riskier proposition. And the third thing is you could manually liquidate some stock to bring down your margin, but you are taking a loss at that point. You're taking a loss on the position. The last step, but last option that I recommend nobody does is do nothing. It's the worst option for you, because if you do nothing, your broker gets to choose how they replenish your margin, and what they're going to do is sell the stock at a loss. Whereas options 1 and 2 at least allow you to maintain your position, and if it bounces back, you get back into the green and be profitable.
So in conclusion, trading on margin can be a highly profitable thing when the stock markets are going up. However, when markets are selling off and you have a margin call and you need to retop up your account in order to service the debt that you've borrowed, you could rest assured that other investors are in the very same position. And because you have a choice to meet the maintenance margin or sell out of your stock, and ultimately, if you don't sell your stock, as we've learned, the broker will do it for you, what you get is an environment of forced liquidation. When everybody wants to sell their stock and margin calls keep getting hit, this creates a really urgent environment of fear. And as fear creeps up, selling intensifies, which in turn fuels even more margin calls, which fuels selling intensification yet again. And this cycle repeats oftentimes until investors are squeezed out of their leverage positions with enormous losses. As you remember earlier in the video, we talked about the most successful investors being the best risk managers. Is there a way to have high leverage? Is there a way to use a small trading account while making profits that allows you to manage your risk to the downside as well? The answer to that is yes. Options trading. If you want to get some insurance for your portfolio in the event that the market goes down, or you even want to speculate because you're pretty certain the market's going to move to the downside, you got the availability of an option strategy called being long a put. And I'd love to explain that to you. In this course, I'm going to take you through what options trading is and how you can use it to manage your risk while at the same time earning higher returns with a small account balance. That's the benefit of trading options. And now you know what margin trading is, the reasons for and against, and you can decide if it's something for you to implement into your longer term trading strategy. So I hope you enjoyed this video. I want to thank you so much for watching. Please subscribe. We got a lot of great content coming your way. And when you do subscribe up top, hit the notifications button so you know when our next video is coming out. Thank you guys so much for tuning in. Have yourselves an awesome day. Manage your risk and trade like a trade pro. Take care and goodbye.